Hello everyone. I'm going to demonstrate the accounting for a foreign currency option designated as a cash flow hedge of a foreign currency denominated asset. So on June 1st, Alexander Corporation makes an export sale to a foreign customer at a price of 1 million pesos and will receive payment 3 months later on September 1st. So that gives rise to foreign exchange risk exposure, which Alexander manages by purchasing a put option to sell 1 million pesos in 3 months at a strike price of $0.062 per peso. We're given in tabular form the relevant exchange rates and option premiums for the peso for 3 calendar dates, June 1st, June 30, which is when Alexander closes its books and prepares its second quarter financial statements. So June 30 is a balance sheet date. And then September 1st, when Alexander Corporation collects on the account receivable and has to decide whether or not it will exercise its rights under the put option. Let's look at the accounting entries that need to be made for each of the 3 calendar dates, starting with June 1st. So on June 1st, there are 2 transactions that we need to consider. Firstly, the export sale, and secondly, the purchase of the put option. For the export sale, the goods are shipped on June 1st, so Alexander Corporation records sales revenue, and the amount is going to be based on the amount of pesos that the foreign customer agrees to pay, but translated into US dollar terms because Alexander Corporation is a US-based company, and so it reports its financials in US dollars. So the notional amount of 1 million pesos is going to be multiplied by the spot rate of $0.062 per peso to get the amounts for the first part of the journal entry, the recording of sales revenue and the corresponding creation via debit entry of the account receivable of $62,000. We enclose the word pesos in parentheses as a reminder that the account receivable represents the future collection of 1 million foreign currency units, in this case pesos. And of course, that has to be reported in US dollars for the reason I just explained. That takes care of the export sale journal entry. Now let's look at the journal entry that needs to be made to record the purchase of the option. So the option is recorded as an asset on the balance sheet of Alexander Corporation, and it is valued based on the put option premium, which is paid by Alexander Corporation to acquire the put option. So that's $0.0025 per peso times 1 million pesos to get an amount of $2,500. So we debit foreign currency option and we credit cash for $2,500. That takes care of the journal entries for June 1st. Let's look at the journal entries for June 30 now. At June 30, we update the carrying values of the account receivable and the foreign currency option. We're going to start with the account receivable, and the spot rate has changed by $0.004 per peso. It has increased from $0.062 on June 1st to $0.066 per peso on June 30. So now that account receivable is more valuable in US dollar terms. So we write up the value of the account receivable by the change in the spot rate multiplied by the 1 million pesos. So that equals $4,000. We debit account receivable for $4,000 and we credit the foreign exchange gain that results in the amount of $4,000. Next, we adjust the carrying value of the foreign currency option, and the value has declined based on the change in the put option premium between June 1 and June 30. And the change is $0.0007 per peso, which reflects a change in the time value of the option over the 30 days. The longer the time to expiration, the more of a likelihood that the option will be in the money, which means that it would be advantageous economically to exercise the option. Now the time frame has shortened by 30 days in the month of June, so there's a resulting decline in the time value. There is no intrinsic value at this time because it is not advantageous to exercise the option on June 30 because the strike price to sell pesos for dollars is less than the rate prevailing in the spot foreign exchange market. So the fair value of the option is the sum of intrinsic value and time value. Intrinsic value is 0 because the option is not in the money. The time value of $1,800 constitutes the fair value of the option. And so we need to mark down the value of the option to its correct fair value on June 30 of $1,800. And so we credit foreign currency option for $700, then we debit accumulated other comprehensive income for the same amount. The foreign currency option was designated as a cash flow hedge, so that means that there's going to be a perfect offset of the foreign exchange gain from the account receivable recognized via a loss on the foreign currency option. So that's the offset. And it's going to be, of course, for the same amount as the foreign exchange gain on the account receivable. So we are going to debit loss on foreign currency option to offset the foreign exchange gain on the account receivable in the amount of $4,000, and we credit accumulated other comprehensive income for $4,000. And also with cash flow hedge accounting, the change in the time value of the option gets recorded as option expense. So the change in the premium from $0.0025 per peso to $0.0018 per peso, that was reflective of a change in the time value. And you take the change in the put option premium times the notional amount of $1 million, and you get a change in time value of $700. And that gets recorded as option expense. So we debit option expense for $700 and we credit accumulated other comprehensive income for $700. That takes care of the journal entries for June 30. Now let's look at the journal entries for September 1st. On September 1st, the value of the account receivable declines by $0.005 per peso, as evidenced by that change in the spot rate from $0.066 per peso on June 30 to $0.061 per peso on September 1st. So we're going to debit foreign exchange loss for $5,000, and we credit accounts receivable by $5,000 to reflect the write-down in the value of the account receivable. With the foreign currency option, there is no longer a time value at September 1st because now the option is on its expiration date. So the measure of value for the option now is intrinsic value because the option is now in the money because the strike price is above the spot rate. So it's advantageous for Alexander Company to exercise the put option. So the component of value now is the intrinsic value. If we look at the fair value, it's declined from $1,800 on June 30 to $1,000 on September 1st. So we're going to have to write down the carrying value of the foreign currency option by $800. And we do that via credit to foreign currency option for $800, and we debit accumulated other comprehensive income for that amount, $800. Again, we have a cash flow hedge, so we offset the foreign exchange loss on the account receivable with a gain on the foreign currency option in the amount of $5,000 to reflect the perfect offset. And we debit accumulated other comprehensive income for $5,000. We also recognize the change in the time value between June 30 and 9/1, in other words, September 1st. That change in the time value was $1,800. So we debit option expense for $1,800 and we credit accumulated other comprehensive income for $1,800. Now, the company collects on the account receivable, receives pesos, 1 million pesos, and they are worth $61,000 given the spot rate of $0.061 per peso on September 1st. So we debit foreign currency pesos in the amount of $61,000. That's the US dollar value of the pesos that have been collected from the foreign customer. And that collection closes out the account receivable of that foreign customer. And so we credit account receivable for $61,000. Now we execute the right under the put option to sell pesos for US currency. So to do that, we debit cash because we exercise the option. We sell 1 million pesos to the financial institution counterparty for US dollar cash, which is 62,000 based on the strike price that is embedded in the put option. So $0.062 per peso is the price at which we sell pesos for US dollars. So we debit cash for $62,000. We credit foreign currency for $61,000. And we close out the foreign currency option by crediting the foreign currency option for $1,000. So that takes care of the journal entries for September 1st. Now let's look at the impact on the income statement of all these transactions. So the impact in terms of cash inflow would be, we start off with sales of $62,000. We have the perfect offsets of the foreign exchange gains and losses, respectively, with their counterparts on the foreign currency option. And then there was that foreign currency option expense, which represented the decay in the time value of the option. So the impact on the net income for Alexander Corporation ends up being $59,500.